Mostly it should be one of the many steps that you go if you're a first timer to options or to getting to know to understand exchange traded options. This is probably a first step on the of many to get an understanding, and obviously these webinars help you assist in there, and so feel free to take the time to learn and whatever we can do to provide information and so on and so forth. So what we're doing today is, as the head of states, we're looking to explore what are options, what exchange traded options, calls versus puts, options pricing, and three common strategies. So what are options? So firstly, let's have a look at the landscape, what happened prior to options. Now that's before exchange traded options. We're going back, I believe 1978, so quite a few years. So if you look at what was there before exchange traded options, you had a choice of a long position, a short position, or cash. So I'd even argue that shorting back in those early days was pretty hard to do. But so let's have a look. So originally you had the choice of going long shares. So we'll come to this, we'll have a look at this payoff diagram. I use it quite a bit and people in derivatives do. If you look at the diagram, it's basically, it looks like a T. So above the line here is your profit zone. Your line down here is your losses. And from here usually starts from 0, forth is where the price movement. So if you look at your options going back some years prior to options, you could own shares, and as you know, if you own or long shares, there's pretty much only one way you can really make money is as the shares go up. And in the situation when you could short shares, you could make money whilst the shares were going down. Or in the terms of cash, i.e. money on deposit, is you have a chance to make some money on interest. So what are exchange traded options? Well, in principle, they are a contract between two parties conveying a right but not the obligation to buy in the form of a call or to sell the underlying security at a specified price at a specified time as agreed in the premium. So as we understand that derivatives in this particular case, or most of these examples, are derived from stock, in the situation of a call, it's giving you the right but not the obligation to buy the underlying shares at a predetermined price and a predetermined time. So as we know with buying calls, or for the people who first come into the options market, to buy calls, we feel that we're long the market. So you'd buy calls in the sense that you believe the market's going up. But another part you can also, things that are options or part of their dynamic situation, is you can buy puts. And with puts, if you buy a put, you're buying, and you're bearish on the market, and you're buying the fact that the market may be going down. So if we use those two scenarios, when you're buying a call, you're buying the right to buy the shares at a predetermined price, the strike price at a predetermined time, which is the expiry date, and you pay a premium therefore for that. With a put, you're buying the right to sell the stock at a predetermined price at a predetermined time, and you also pay a premium for that. So you have the right but obligation to do so. Okay, options, components of options. Every option contract has, well, for a lot of the examples we're looking at today, we'll be looking at the shares, so the underlying security being the shares. So as you can see, there's a few you'll know is ANZ, BHP, Rio, Telstra. Also, you'll see there the XJOs, and that's over the ASX S&P 200 index. Another common component of an option is the expiry date. Now, all options have expiries because hence they're derivatives, they're not the stock themselves. So you're buying the right to an event in the future. So if that event, you pay for that, and so you'll have an expiry date. So all options, or most options, are not open-ended, so they have a finite time. So If you buy an option, you might buy a near month, somewhere between 1 or 2 months, a mid-month, the 3 to 6, and maybe longer months to a year. But at either rate, all options or most options have an expiry date. And we have a strike price, which is very important in determining how about you go about an option. So for instance, let's use the example of Telstra. Now Telstra, as you know, have been trading around that sort of $5.50 mark for a while. So if we were to go out and buy a call option in Telstra, perhaps one of the options you could use is a strike price of $5. And that $5 point is the point of reference to where you believe, or the starting point of where the options moves in relation to your stock or the strike price. Now, a common thing is to trade these options market, you don't get to do so for free, and to buy into these situations where you're looking at the future movement of the options, it does cost you a price, or it's represented in the as in the premium or price. And also another point of consideration, a very important point, is what type of option you're looking to trade. Again, if we look at the two scenarios, we have a choice of a call option and a put option. And traditionally, or people who go to buy a call option have a bullish view on the market. Conversely, is if you think of what could be the polar opposite of a call, you would think about a put option. So they're the two types or styles of options that you can buy. A call option meaning that you're bullish on the market, and a put option meaning that you are bearish on the market. Another point of what our understanding is that the options, especially exchange traded options, are over many different stocks. And as you can see there, we have options over 71 stocks. I think we've had 1 or 2 additions since we've taken this consensus, and we have one index being the S&P ASX 200 index. So calls versus puts. So call versus puts, the rights and obligations. A call, you're buying the right to buy the underlying security at a predetermined price and time. And as we mentioned before, with a put option, it's virtually the opposite, or it is the opposite. So to buy a put, you're buying the right, but not the obligation to sell the stock at a predetermined price and time in the future. Remember that any time that going into these options agreements, when you're going to buy options, that you can buy or sell out. It's supported similar to most markets, so you'll find there's bids and offers. So that every time you get into an option, there's generally a market supported there. So if you wanted to go in and obviously to buy your option, you have to go to the market. Same situation. If you wanted to dispose of your option or sell your options, you can do so at any time. So the buyer of the options holds a long position and has the right to purchase, it's in the way of a call, or sell the underlying instrument, as in with a put. And again, we bring up these contracts. So there's a specified price, or the strike price. As I use that example with Telstra, we may have bought the $5 call, and we have the ability sometime down the track, for instance, if we bought the $5 call and the stock had gone to $5.50, we could exercise our right and buy the stock at $5. So that is denoted by the strike price. The specified time, and as mentioned, with all options, they have a finite life. They don't go on forever. So depending on the options you can look at near months, like I said, 1 or 2 months, they're all listed, to 6 months, there being the mid amounts, and then from 6 months to a year, you'll be looking at longer dated. And again, it's not a free ride. We don't get these options for free. We pay a premium for the right to participate in what we believe will be the movement of the future for those stocks or indexes. As sort of mentioned before, these agreements we're talking about gives you the right to buy a stock, or in the case of long put, to sell stock. And all this sounds probably a bit confusing, but as mentioned, these options are quoted in the market, so we can dispose of our rights at any time, or we can sell our options position at any time that we feel. So we're not bound by just those obligations of delivering stock or buying stock or selling stock. We can sell them into the market prior to or up to expiry. So just a quick recap again with our obligations. The call gives us, I should say particularly on the reverse side, we referred to the options from the buy side. On the calls, it gives us the right to buy the stock. On the put side, it gives us the right to sell the stock. If you look at it from the sell point of view, if you're short an option, it's virtually the opposite of being long an option. So you have the obligation to sell. So if you were short an option and another counterparty exercised their right to buy the options in the market, and you were assigned, you would have to deliver that stock. In the opposite to that with the put, if you were short a put option and the buyer had exercised their right, you have the obligation to buy the stock. So the option seller or the creator of the short position, to recap again, is obligated to sell in the case of a call or purchase under the case of a put at a specific strike price. Again, if we use that old example of the Telstra, the $5 call, at the specified time. So if we'd gone out to March and bought an option in March, it would expire in March. And again, we would pay a premium to participate in this situation. So once sold a position, again, as we mentioned before, you can establish the short position, you can buy it back at any time leading up to expiry. So just again, a final recap. Long a call gives us the right to buy the stock. Long a put gives us the long a call gives you the right but not the obligation to buy the stock. The put gives you the right but not the obligation to sell the stock. But on the short side or the sales side, you're obligated to deliver the stock. On the put side, you're obligated to buy the stock. And there we go. If we look at our break-even chart, as we see before, if you look at the profit area being above the line, the loss below the line, with a call position, as the stock rises, we will make money on our call. As the market falls with a short call, we would also have the ability to make money, but I don't really want to go into the short side too much at the moment. So with all positions, we have the strike price, the life of the option, and the premium. Okay, some key points you need to know about your options. Equity options, the contract size is 100 shares per lot. So each options you buy is the equivalent to 100 shares. So if we use our Telstra model, our $5 call, we go out, we buy one contract equals 100 shares. So if you exercised your long position, you would end up with 100 shares. Again, if we use that strike price of $5, it would be at $5. Each option has an expiry date, and it's the last Thursday of every month, providing there's a business Friday. These are we have American style options and we have European style options. Now the point with the American style options, we can exercise our position at any time prior to the expiry for the people from the buy side. With the Euro styles, you can only be exercised on the date of expiry. Now index options, they have a contract value of $10 a point. The expiry date is the third Thursday of every month. They are European, so they can't be exercised only until the date of expiry, and they are cash settled, not physically settled. Some people find this attractive. Obviously, we mentioned with our options contract on the underlying stock, it is physically settled. So again, if we exercised our 100 Telstra at $5, we take on a physical position of 100 shares of Telstra at $5. As with the index, it's very hard to physically settle because there's 200 shares in the index. It'd be almost impossible to do so. So the S&P ASX 200 index options are cash settled again at the expiry date, which is the third Thursday of every month. Options pricing. So this is always a good one to know, because I think a lot of people who trade the options market find options pricing a little perplexing. Again, when you have options, you have options over many different stocks. As we saw earlier in the slide, we have 71 stocks and an index. And so out of those 71 stocks and the index, they all behave very differently. You look at a stock, for instance, like a CBA, a BHP versus a Telstra. They all move in different ways. It's fine. Stocks traditionally like Telstra tend not to move as much, and you've noticed that stocks like BHP of late and CBA tend to move in very erratic things. And this all affects the options pricing, but we'll get into this in in depth further on this slide. So some major factors in an options pricing. Firstly, if we look at if we've gone out and we've bought a 350 option, or we have the exercise price of 350, the stock is trading at $4 currently. An important component of our options, especially we'd be looking at a call option, would be the intrinsic value. So if we're long a call at 350 and the stock is trading at $4, we could most or 9 times out of 10 would safely assume that the intrinsic value would be at 50 cents. So another very important component, and in some ways it's the largest or has the most erratic or the most swing in the pricing, is the time value. And what's the component of a time value is the time expiry. You have things like you have your dividends, you have interest rates that pay a smaller amount, and largely you have a thing called volatility. Now, as you probably know, or as I'll explain, volatility is the peaks and the troughs. So the higher the volatility is the measurement of the peaks and the trough, and also the time that the peaks and troughs are achieved. So if you find a stock that's hitting very highs and then hitting lower lows, and they're doing so in a very short time, you'll have a high component in your volatility. Some people tend to think when you look at volatility that it's it could be a situation where you have a market that's falling. For instance, you might have the Dow or the ASX 200 correct itself 3%, and then consequently correct itself in smaller amounts over a coming week. Now, some people might feel that that will increase volatility. Well, in turn, yes, in the short sense it will, but as the market tends to trend in a certain way, the volatility component and the market gets the feel of the way the market's going, and the volatility will shrink. We'll move on. So in looking at an options price, if we sort of go back and we looked at the 50 cents intrinsic, which was the difference between, and this is a call option, the 350 strike price, the $4 being the actual share price, 350 minus 4 equals 50 cents, and the time component of 22 cents that would give us a premium of 72 cents. So when we get an idea of how options are priced, we can look at that, and that will give us a fairly fair idea of how the premiums do come about. So in this particular case, to take on this particular option, we're not too sure of the time in the example here, but we're looking at a premium of 72 cents for this option. An important part of the terminology also is whether a option is in, at, or out of the money. So if you look at a particular option at this case, we're looking at a stock that's at $4. So we're looking at what would be in, at, or out of the money in calls, a call option. So if we have a look here, we look at our $3 series. Well, it's a call option and the stock's trading at $4. We are definitely in the money there. We're $1 in the money. If you look at our next series up again, it's at 350, so we're 50 cents in the money. So it's also considered to be in the money. At the money would be where the stock is trading. So if you had a $4 call, that would be considered to be at the money. If we go a little further, if the stock was trading at $4.50 or $5, that would be considered to be out of the money, which is important terminology again with options. So if you took this slide and flipped it on its head and you introduced a put option, a $4 put option, you'd find that it would be exactly the opposite to this scenario. Another point to cover with the options pricing is what they tend to colloquially call the Greeks, theta and delta. We've covered a bit really in short, so we'll have a further look to see if we can explain a little bit more with the options pricing when it does come to the theta and the delta. So when we look at theta, it's a change of options price given a change in the time to exploration. So it's to do with the time component of an option, and as the option's expiry gets closer to its expiry, the theta component comes out of it. The longer the time of the option, you'll find that the theta component is higher. We have a slide to illustrate that a little bit further on. So this time component is, as mentioned, it's a very important part of an option. As you know, as the longer the time is for any particular stock, you have a greater chance of either getting it right, and I guess conversely, you have a chance of getting it wrong. So the shorter period you trade, the event that you're looking for is you've got less time for it to happen. If the longer the amount of time you buy, or so if you buy a further dated option, you've got more chance of, in most cases, of getting your decision right. But it comes at a cost, and the cost is time decay. And so if you buy a position that has some time, as it gets closer to its expiry, the time will decay, as mentioned. So here's a little bit of an illustration of how the time decay affects an option. And you find here, if you look at the first half of an option, you lose about a third of its value through or theta or time decay. The second, you lose 2/3 of the option's life. So, and that kind of makes sense, because remember, when people price options, they're pricing to the ability of an options to move in a way, one or another over time. And then if you take, for instance, if you give it more time, the chances of that getting right. But as the time comes closer, people's speculation on a particular option or strike or stock becomes more realistic, for instance. So for that event to happen, so if you were long a stock and you bought an option that's 6 months out and the volatility was quite strong and you looked like there was quite a good chance for your options to make it there, but if your option had stayed fairly stagnant during that first 3 months, you would notice that you would have quite strong time decay, and the market would start to speculate the actual chances of that option, your decision, or the chance of that option's coming into play, or your decision into fruition, is starting to decrease by the day. So the delta, I think, is a lot easier to understand, and it's the change in the options price given the change in the price of the underlying stock or the index. So for a dollar change in the underlying price of the stock, how does it represent an option? The delta is a really important, I think, is a great thing to know when getting into options, because especially around the point of when you're trying to execute your trade in the market, it'll give you a very fair idea of where you're actually going to get set in the market. So let's have a look at the deltas expressed in percentages. For in a call, we have what's called a positive expression. So if the stock goes up, as we know when we look at a call option, the option should also go up, and it should go up in a certain relationship to the way that the stock goes up. The way that the delta is calculated in a stock, if you go back to our in, at, and out of the money, will determine how high the delta is. So the higher the delta, the stronger it will track with the stock in a positive sense in a call, and also how it will track in a negative sense in a put. So as mentioned, with a call, as the stock goes up, it's considered a positive delta, so it will have a positive effect on the option. As the stock goes down, it'll have a negative effect on the call if you're short, And on a put, if you're long the put and the stock goes down, it will also have a positive effect, because so we'll get an idea of this sort of situation of how deltas are calculated. So when we look at what's out of the money, the delta, as you can see down here, it's represented in the smaller sense, so it's 0.1. So if we're looking at a call option and the stock rallies, 10 cents, we'd only be looking for this particular option to rally a cent. As the delta gets higher or closer to being in the money, and particularly around at the money cents with 0.5, we will see that if the stock rallies 10 cents, the options will rally about 5 cents and so on. So again, at the money, when we're looking at those, we're sort of saying that at the money, we're looking at about a 50-50, and that makes sense. If we look at our Telstra scenario and the stock was trading at $5 and we had a $5 option, the chances of it going up or down, at best, some of the best market pickers can only get it, you're right, 6 out of 10 times, so, or 6 or 7 out of 10 times. So for most of us to know, or most of the market to speculate where something's moving from at the money, is a bit of a toss of a coin in some senses. So that's why you'll find when a stock is at the money, the delta is trading at 0.5, and as mentioned, if your stock goes up 10, that should represent a 5 cent move in your option. But as you're in the sense of a call option, as the stock continues or as your option becomes further in the money, the delta also increases. So if we look at something that goes deeper in the money or deep in the money, we're looking at something like a delta of or closer to 1. So for every cent the stock moves higher, so does our option. So if we look at an example, if we bought our Telstra $5 call and it's trading at $6, we'd probably expect a delta close to 1. So for every point that the stock moves higher, so does the options. So just recap on a few options pieces and terminologies. We look at the options taker rider. The taker is normally the buyer in the sense of an options. It's it's a bit of an old term. The rider is in fact the seller. Exchange traded options, and that's what we're talking about here. We're looking at exchange traded options, and these particular options that we're talking about are traded on the ASX, to which CMC are a member of. Calls and puts. So I think we've covered our calls and puts quite strongly here. So as we mentioned, with a call, if we're long a call or we've bought a call, we're taking a view that the market's going higher. If we're looking at puts and we've bought a put, well, we're assuming that the market is looking to go down, or that's our assumption. Our exercise price, if we took our favourite with Telstra $5, our $5 strike would be our exercise price month. Like I said, most options have expiries in nearly every month, and they go out from as near as we are in December now, and they can go out as far as December of next year, and some even further. We have an expiry date, and as we mentioned, in most cases it's the 4th Thursday of every month. Given that there's a business day the next day or a trading day. And the premium, as we've also seen, is the premium is what we pay for what we think the movement of the stock will be, or our point of speculation. So again, if we went out and bought our Telstra $5 call, it may have cost us 10 or 15 cents to participate in that situation. The intrinsic value, as we saw, which is the difference between the strike price and the share price. The time value, again, that little component in the options that is the strike price less the stock, and whatever's left over would be considered our time value. In the money, at the money, and out of the money is what we've also covered. So there's some very important terminologies in how things will be determined, what is in and out of the money. So as a little bit further, We've got 3 common strategies. I think we'll probably only go over 2 of these strategies. We may go into some of the written strategies in another seminar into the new year, but we'll just look at the long side of things for today. So we'll look at a couple of strategies that we can use. So buying calls, buying puts is what we will be looking at. So as mentioned, if we're looking at buying a call, we believe that the market is bullish. If we go long a call, we're assuming that the market is looking to move higher in the near term, preferably the near term. So are buying calls risky? Well, I guess it's a matter of opinion, but we'll go for a little bit further and look at what our pros and cons are. Now, buying calls ensures that you only buy stock after the market confirms your decision. So again, if we go out and buy that $5 call and we're at March next year and it's trading at $6, well then you'll understand what it's been after the market confirms your decision. Your money would be, or your situation, your call value would increase. And the option would, or the market value of the stock would increase, and hence the follow-on effect with a call. You're buying leverage within the component of the option. Like I said, you're only buying the stock if and when you want to, and the market confirms it. So if you want to, you're happy to buy the stock once the stock's risen high. If you exercise your call, for instance, that $5 call in March, the stock's trading at $6, you're buying the stock at $5, and if that's what you want to do, that's great, and you've made a profit in that sense. Again, you can dispose of your option at any time leading up to expiry. You're going long with limited risk. When you're going long, you don't get closed out before the expiry. So when you're long the position, you will not get stopped out, you will not get closed out. So we're going to run through a few scenarios. If we use the example of the AML, fictitious stock, the AML March $4 calls. And as we know from previous discussions, that the buyer of the call has the right to buy a standard quantity of shares. So if we're looking at the stock AML, we're buying the right to buy AML shares if we choose so. And an exercise price of $4, so we'd be buying the stock at $4 if we chose to exercise our right. Expiry date is September, and the number of contracts is 10 contracts. So the underlying options value, or that most options have 100 shares for the underlying, so that would be 10 times 100. So our stock equivalent would be around, or would be 1,000 shares. So again, like if we find that we were short this particular option and the buyer or the opposing position exercises, if the buyer or taker exercises the option on or before the September expiry date, the writer, which is the person who's short the very same options, must sell those shares at $4. The writer would have received the premium, as we sort of looked at that Telstra. We was talking about buying the options, and it was going to, we thought maybe 15 cents. If the sense that the person who sold us those options, they would have received that 15 cents. And this is I think, a very good illustration when it comes to options. If we look at the life and cycle of a call option. Now, this will show you quite a few things, I believe. If we look at what's happening here, if we look at the movement of the stock over that 9-month period, we can see there's a fair bit of movement in the stock. We're looking at the share price here, and we're looking at some options prices here. So again, we're looking at that. If we go back, this is an example of the AML $4 call. So we can see the way that the shares have moved over that particular time, but how how does it affect the life of an option? As we sort of mentioned, when an option starts out and you buy a fair bit of time value or theta, you can see that the time value, if you look at the difference at the options price versus the share price, as the option starts out, the time value is quite decent. And as you can see, as the price moves on, and also is a really interesting situation here, it's still fairly, well, about halfway. We can see that the pricing has moved very close. And that is because we can see there that the market's moving in a way that's almost confirming our decision, and the market's pricing into the fact that the options are moving in a way that will sort of dictate that the market will keep moving. But as you see here, the share price falls and a little bit of volatility starts to take its way. The time component, even though time's moving on, has grown again to here where the share price has gone well under. The only component of the option is the time value here, and then when you get back to expiry, where it finishes at 420, you can see the time value's completely gone out of the option altogether. So if we look at the rules of buying call options, you would not consider buying a call option unless as a sole strategy unless you are bullish in the market. I think we've covered that, so we kind of understand that. We wouldn't buy a call option unless we were quite bullish on the stock. So if we look firstly at some payoff diagrams of how options will move. So for instance, if we look at AML shares at $4, and we looked at our AML March 350 calls, the premium we paid when we went out, if we wanted to go out to buy them at the time, was 72 cents. We looked at, we possibly could have gone out and bought the $4. The premium there, or to buy the right to participate in that option, would have been 38 cents. If you look at the March 450 calls, buying the right there of around 16 cents. And again, given that the stock's at $4, the pricing makes sense because obviously the $3 is far deeper in the money, and as we move out, so on and so forth, the value of the options become out of the money. So that kind of makes sense in our term, that when we look at the premium of 72 versus 38 versus 16. So we've got something that's in the money here, at the money, and out of the money. So let's have a look at an example of if the shares went to, say, $5. The expiry value of your 350 option would be around $1.50, and that primarily at that point, as it gets to expiry, we know that time value comes out of an option. So if you look at that difference between the strike price, the share price and the strike price will be $1.50. And if we'd taken our 10 minus our 72 cents premium, or our expiry value is $1.50. If we bought those at 72 cents, or we possibly bought those at 72 cents, the profit would have been $780, which would have been our 10 contracts less 150 times the contracts would have come to $7.80. Our return would have been 108%. If we look at our $4, which finished $1 in the money, would have been our profit there would have been $620 at expiry, which would have been the value of the dollar less the premium we paid, which is 38 cents times 10 contracts, which would come to 620, or a profit of 163%. Now our March 450 calls, I think they cost us 16 cents less the 50 cents. The value of the option at expiry would have been 50 cents in the money, so the value of the options at expiry would have been 50 cents, less our 16 cents, times our 10, we would have made a profit of $340, and our percentage would have been, we would have made 213%. So as you can see, the difference between making money sort of in, at, and out of the money is quite high. but also to understand that what our break-even points would have been. So our 350 calls, our stock would, to break even, would have had to be over 422 as we paid 72 cents. Our break-even point of our $4 calls would have been $4.38. So the stock would have had to finish at 438 or higher to break even. Our March 450 calls, our stock would have had to finished at 466 to break even alone. So, but anything over those prices, we would have done well. So when we look at those different prices, that's the increase over those there. So we can see that if we'd taken that venture and the stock had finished at $5, it would have been a profitable situation. But conversely, if the markets fell below those break-even points, we wouldn't have made any money at all. So the second rule of buy and call, the more bullish that you are, the more you consider out of the money series. So if we look at, I believe in this situation, if we looked at, this is an example, if we bought the AML $4 calls, which is pretty much at the money. Now if we bought the stock and the stock went to 450, and we bought the options, this is a diagram to show you how the leverage in the option has worked well for the investor. So if we bought the stock and it went to 450, we would have made 500. That much is fairly self-explanatory, or 12.5%. With the option, with the AML $4 call that we bought for 38 cents, so it cost us $380. At the point of the stock going to 450, we would have made 76%. That's not really showing there, but that would have been 290, so which would have been 76.3%. But there's an indication of what leverage costs. So for instance, if we got it wrong, and we use the example, if we'd bought the stock and it goes to from $4,000 or $4 to 350, this is in premium here, we would have lost. And again, with the options, it costs, if we bought the AML $4 calls at 38 cents, it would have cost us $380, where the stock would have cost us $4,000 if we'd bought the stock outright for the same example. If we look at what we would have lost, with the stock, we would have lost $500, but we'd still own the stock. With the option, we would have lost $380. If you look at it this way, with the options, we lost, with the stock, we lost 12.5% on the shares, but we still own our shares. But with the options, we lost 100%. So that gives you an idea how the leverage can work for us and can work against us. So again, if we look at a diagram of how that price movement is represented in a payoff diagram, so we're looking at, we bought the option at 38 cents, so it starts below the profit line because it cost us. And if you look how the stock moves, our break even, well, our strike is at $4. Our break even would be at 438. So as the stock moves, you can see it costs us 38 cents to buy. That's our strike price. As the stock continues to move higher, we would need to at least go to 438 because the cost of the position is at 38 cents. So our value of our option isn't going to be realized at expiry until the options moves past that 438. So that's considered our break-even point. And everything over that 438 is what you'd be calling blue sky. So again, with the bought call summary, we pay a premium. So for instance, when you look at those AMLs, I think we paid 72 cents for the 350 calls. For the 4, we paid 38 cents, and also for the 450, I think it was 16 cents off memory. So to buy the position, to participate in this particular trade, or where you think the stock's moving in the future, it does cost a premium. Now, the risk-reward scenario, the risk is basically the outlay. So every time you buy the option or you long the option, that risk component is concentrated in the premium. So whatever you pay for the option is already considered in the premium that you pay, and you can't really lose any more money than that original outlay. And I hate to use this terminology. Theoretically, the reward is unlimited, but let's be realistic. The stock doesn't keep going higher forever. There is a limit to its rally point. But people would like to use that point that there is a chance of unlimited reward, which again I take with a grain of salt. The break-even point is important to know. Your exercise point, the price versus the value of your stock. So you need to know where your break-evens lie. As we looked at some of those positions there, you remember how we saw the break-even points. I think the first one was 422 and so on and so forth. And you've got to look at your view in the market. So as we sort of go over with the calls, you have to be bullish, and you want your decision edified, fairly early for it to really work for you. At any time for the options, though, if it rallies strong enough past your strike price and the premium you've paid, your view is edified at any point. A reminder that you're not bound to this contract till expiry. You can go to the market at any time and dispose of your contract, or just you can sell out at any time in a long position. Remember also with the puts, you're taking a view opposite to what you feel when you feel bullish to the market. So you're in fact quite negative the market, and if your view of the market, you go out and buy your put, again, it's either edified by the movement of the stock on a downward trajectory past yours or lower than your strike price and further lower than the premium you paid would be your break even. So we're going to look at some of the puts. Again, we'll look at a strategy in regards to maybe a bit of portfolio protection and puts, and we're getting close to time, so I'll have to wrap it up. We're getting close to that hour. So let's have a look at a portfolio protection scenario. When we looked at the options earlier on, like I said, there were 71 options and one index, and so we have options, we have S&P ASX 200 indexes options, and that basically covers our 200 index and tracks to them. So let's take an example. If we have a basket of shares conveniently at trading around a market value of 59,500, that seems to conveniently track the ASX 200 quite well. And the ASX itself is actually at 5,950, which is quite bullish at this point. So if we're looking at our portfolio, and we assume we're still bullish on the market, but we feel that maybe the market's heading for some short-term headwinds, and we feel that there could be a bit of choppy sort of situation or a bit of volatility entering the market. So we may feel the need, again, like I said, if we look at here, we might be thinking there's maybe a bit of a correction. We're long-term, we're quite bullish on the market still, but short-term we feel there might be a bit of a hiccup. So we've got this portfolio. It's worth currently at 59,500. Again, conveniently, the market is tracking it at 5,950. What can we do? Well, we can consider buying some protection. We could look at going out and buying some put option in the XJO area. So we have a look in there, and we can notice that we had an S&P ASX 200 September 59.50 put, and at the time it cost us a premium of 160 points, or for each position, for the position itself, for the one contract, it cost us 1,600 per contract. Again, so to take a view or to protect your position, it's not for free, and as mentioned in this particular case, it was the premium was 160 points, which equated to a cost of 1,600 per contract. So again, our scenario, we've gone out and we've bought that put option. We own our shares at the value of 59,500. We've now bought our put, a 59.50 put, which cost us $1,600. So our break-even point at this moment is the index at 61,100. So ultimately, as mentioned, this is a protection, so we still hope for the market to move higher, but that figure here is the value of the 59,500, the value of our shares or the index, plus what it takes to cover the cost here of 1,600, which would be 61,100. So just to recap, anything over 61,100, we're still quite happy. Our insurance cost us 1,600. Our limited downside is 1,600. Because we've managed to find an option that tracked the value of our portfolio and the stock was trading at that price quite well, we're actually completely protected to downside movement, but again, it costs us 1,600 to do so. So at our point when we first took this out, our index was trading at 59.50. We need the market. We're long-term bullish, but we're covering against a short-term thing. So we're happy for the stock to go higher, and everything rallying over that $1,600 would be considered still in profitable territory. Now, the way XJO put options work is for every tick that the market goes lower, it in a put sense will be in positive 10. So you make $10 for every point that it ticks below that 950. So let's look at if we started to, our losses are limited whilst this put is in play to 1,600, which I mentioned was the premium we paid. So for instance, if the market fell quite heavily and where the index was sitting at 4,900, that's a pretty big fall. Our stock position, if we were uncovered, we would have lost about 10,000 on our stock position. Our options position, on the other hand, as we tracked with the market on the low side, the options tracked and it was increased in value to 8,400 because the put option, it made money as the market fell. Even though your portfolio decreased, the option increased, and that's what we were looking for. Our total P&L is $1,600, which was our options. Now, again, you know, in that particular situation, if your portfolio dropped $10,000, that cost of $1,600 would have been money well spent at that moment of time. So if we're looking at the option indexes at 54.50, again, our portfolio, conveniently enough, is tracking the index. So at 54.50, our portfolio has lost $5,000 here. The value of our options at 3,400, and the total P&L or the cost is 1,600 for the position. The stock is tracked at 5,900 or at expiry. So unfortunately, it's not the best outcome, but not the worst outcome either. At 5,900, the value of our option, it cost us 1,600. It's the stock, our portfolio has not moved, so the value of portfolio is at zero. Our options cost us 1,600, so we're out of pocket 1,600. Again, if the stock moved higher to 64.50 level, so the index is 64.50, the value of our portfolio has increased to $5,000. The cost of our option was $1,600, so our total P&L is 3,400, which was the value of our P&L. Again, if we go a bit higher to labour the point, the index is now 69.50. The value of our stock's at 10,000, and the cost of our XJO position was 1,600. So our total P&L was the 10,000 less the 1,600 was 8,400. So at that particular time, you know, that $1,600 amount, even if it didn't work out for us that well, it may have allowed us to sleep a little better at the time. So it may have been money well spent. So as to recap on that, it acts like an insurance. There's a minimum risk to this. For example, the cost was the $1,600. The thing is that the insurance is the same with all options. It has a life, and if we went past September and we still felt the same, we may have to re-enter another put position, and it may start to get a little costly. In that original example, it cost us of $1,600 or around about 3% of our portfolio. That's pretty good, but if we keep spending 3%, it will erode on our portfolio over time. So the benefits of protective puts, well, it's basically quite simple. Their limit risk to is a predetermined amount, which is the money we spent, which was $1,600. Also, the problem is that in that example, it was quite a neat example, maybe a little bit too neat. So your option may not always track the index 100%. So you could underperform or overperform, and so the cost of underperforming is obviously your protection will not track the fall of the index. The cost of overperforming is that if the market does in fact fall and you're overprotected, well, the value of your put protection is increasing at a rate greater than the fall of your index, which is all right, but it comes at a cost. So if you're overprotecting, it also does cost you a little bit more money. In that particular case, it was 3%. If you overprotect, maybe 4 or 5% or something along those lines. Okay, again, the risks are they can be expensive when the volatility is high, and the premium paid flexibility can result in underperformance, and again, that can come down to how you set your puts and the cost of your puts versus your portfolio. So I think I'm starting to go a bit over time. I apologise for the late start. Also, if we looked at that case there where we're not when we haven't got a portfolio but we're negative on the index, if we've just gone out to buy those puts, those returns that you saw on the puts are still valid. So if you didn't have a portfolio, another interesting use of the XJOs, you can from if you go long a call scenario, each contract is roughly about a value of a portfolio of about 50,000. So it's also can work another way. If you've got a bit of money and you don't really want to jump into the market because you're a bit unsure, you can get exposure to the market by buying an XJO. But I think it's time that we wrap it up, and I'd like to thank you very much for attending. I've got a few one or two things. It goes questions here. How do financial markets benefit from people trading options? Well, to be honest, it is just another product. So there's all kinds of products out there, and they all affect financial markets. They aid and assist, and also in some situations they can detract a little as well. But they are, after all, just a product. If you're looking to trade options, I think, as mentioned earlier, that this is part of a long journey in a way. It's to get the education you need. Don't feel that you have to jump in. Don't feel that you have to set up an account and trade sooner than when you're comfortable in the understanding of your options. Again, if you're starting out, start simple and start slowly and get a feel of the markets and your positions you're looking at. I'd again like to thank you for listening. I'd like to thank also the ASX and for being a partner for us, and we've worked in this education process for quite a while now, or quite a few years, and I think we've had some good traction. And I hope you all got something from this. And as I mentioned before, you look at your watch or you look at your date, and then there goes another year. So I hope you've had a good year and you have a great Christmas, and hopefully the next year is a great year for trading. So thank you very much for your time, and we may do another series on the short side in the new year. So thank you very much, and have a lovely break. See you.